Is your retirement account getting dumbed down by target retirement date funds? I'm James Studinger, financial planner and author of Wealth is a Choice. I do believe that wealth is a choice and that people get wealthier by simply buying things that make them more money. I have a pet peeve with dummying down of retirement accounts. I think that we have a big problem in our country, and that is that most people don't have enough money to retire. Few people have enough money in their retirement accounts to replace what pensions used to do. Some people decided that retirement plans are too complicated for most people, and they scare most people away from investing into them. To counter this, they reduced the number of investments available and came up with a menu of investments they commonly refer to as target retirement date funds, like 2035 or 2030. The theory is that if you buy the target retirement date fund that has the year that you plan on retiring as its name, then the investment will automatically reallocate perfectly for what your needs are. I wish that instead of taking the dumbed down approach, they worked much harder at investor education, helping people actually turn these investments into $1,000,000 or multi-million-dollar accounts. But that's another story in a much longer video. First of all, if you watch my 10-year burn rate video, then you know that I believe investor allocation into stocks and bonds is an individual selection and not determined based on somebody's age or what date they might retire. When people retire, they transition from putting money into investments and saving to actually taking money out of their investments for spending. They're no longer earning a paycheck, so they must become their own payroll. That means you actually have to sell some of your shares, a portion of your investment, to spend money for fun and for bills. It's kind of like taking money out of your bank account, except that investment accounts go up and down in value every single day. So when you're spending money in retirement, you want to take your money from something that is pretty stable and not something that's really volatile. For example, if you sold $10,000 from an S&P 500 investment fund and the market went down 5% that day, then you would be selling more shares to generate the $10,000 you needed. If you sold an additional $10,000 the following month and the market was down 15% from the last time, then you'd be selling even more shares to generate the $10,000. Your portfolio has lost lots of money, and unfortunately, some of those losses are permanent because you sold away the shares. If, on the other hand, you sold $10,000 from a stable investment, and later in the year, the S&P recovered all of its losses, then you didn't lose anything. And this is why I don't like target retirement date funds, because they lure people into thinking that the investment is more stable and worthy to spend from, as it's not as volatile as the S&P 500. For example, now in the fall of 2023, if I look up the investment mix of the Vanguard Retirement Date Fund 2025, it has 55% of its investment in the stock market. That means every time you sell a share of that fund, you're also selling some of your market assets. And if those equity assets are down, then you're selling them at a lower price. And when the market comes back, you won't own as many shares, and therefore you'll have a permanent loss. Instead of people investing into a blended mix of stocks and bonds within one fund, I prefer that people invested directly into some money into stocks and some money into bonds. And then when they want to sell something, based on what's going on in the market, they can decide if they want to take some money from an equity position or if they want to take some money from a fixed income position like a bond. And if they've done their math on the 10-year burn rate, they're not selling equities at losses and they're not creating permanent losses then. Managing your money should be a fun and liberating experience. Call us if you need help with your own unique situation and share this video for others to learn from. For those of you that like to get into the details on your own, while not as robust as what we have available within our office, we do have some free resources available on our website.
Ta-da!